So yeah, we're negative on the stock market. We're very positive on the monetary metals. We think in the next 5 to 6 months, you're going to see, for example, gold continue up, but silver explode.
It looks like it's already exploding today, and we're up to 36.50 today. It's up almost 50 cents.
Yeah, no, that's you're using the spot contract there, I think, or spot.
Yeah.
We use September silver right now, and September is trading at 36.70 something. But you'll see the explosion that occurred in April, and it blew through the two $35 highs that existed. Mm-hmm. One was in last October, and then there was a $35 high in March. Those two peaks, yeah. So double top. They tried to break down hard in early April, trying to act like they're the stock market, which they're not. Silver follows gold and always does. Exploded through those highs and has held its ground despite constant selling for the last 4 weeks or so. I think you touch 37 again and you're going to be gone. Or they're going to realize this isn't topping. This is just a pause. I think silver has a very strong chance between now and year end of taking out the old dual highs at $50. I guess they're phantom highs anyway. They were hardly up there at all in terms of duration, and going into the $60, $70 range. And I'm not saying that's a top. I'm just saying that's next pause point maybe. But I think that the important part is the surge. I think silver could basically double. That's what I'm saying over the next 6 months. Now gold will go up nicely too, but silver will outpace gold on a percent basis. So that personally, that's my focus.
Yeah, and you're still dealing with pretty much a 100 to 1 gold to silver ratio or silver to gold ratio.
It's ridiculous, yeah. No, it's historically cheap, yeah. It's firming. Silver's firming versus gold.
Yeah, this is silver relative to gold, so you can see the
long way back. These are very. In other words, if this were a price chart and you know it's not going to zero, what do you think about it? Are you bearish, or you look, hey, maybe this is a bargain? Okay, it ain't going to go to zero. Okay, and I think that next upturn could easily take you up to there. You've got it expressed the way we do, to the 2% level easily. In fact, if you go back, you go back quite a ways here. The number of the past 50 years, going back to the mid 70s, where we get up there to 6.5%, silver has reached 2% in 21 of those 50 years. So it's almost routine to be at least 2%.
Right.
And we're right now 1.09. Okay, almost 1.1%. So it could double in relative performance just to get to the 2% level, which isn't that's not even a big achievement.
And that's assuming gold stays constant.
Gold's going up during that time.
Mm-hmm.
It's just that silver's going to go up. Instead of being 1% of the price of gold, it'll go to 2%. Because whenever the spread goes up, by the way, the metals both go up. It's never a case that silver doesn't go down and gold goes down more. It's always the case that when this spread rises, silver's going up more than gold. Deficit spending and so forth that is ongoing. There's guys like him that don't quite latch on to the Trump movement. So I could easily see, especially if certain things happen that aren't supposed to happen, like commodity inflation comes back. Well, why is that happening? Trump, et cetera, that you could have fragmentation there. So maybe the two-party system will evolve into something else, like a multi-party system they have in a lot of countries, very fragmented. All kinds of changes like that could occur exterior to the markets and are likely to occur, because I think these market events are going to be very impactful to the average guy.
Yeah, especially in regards to some of the younger demographics. I mean, I'm probably younger than a lot of people that watch my content. I can tell you a lot of my friends do not associate with either Democrats or Republicans. They're kind of they're both antiquated parties.
But
so
a lot of things like that up in the air. The 52 card pickup, I think, is coming, not just in markets, but in. By the way, there's one market we haven't mentioned. I want to mention dollar index. Dollar index has been dull, dead quiet between 2023. 2024 and even into early part of this year, where you could, if you got a chart of the dollar index, you had that run up into 2015, and then you dropped hard into 2023 through 2024, and you stayed in a narrow little range. It was about 8% wide for 2 years. When they tried to break out of it, we put out a report saying, don't trust the rally. It's a breakout on the price chart, but it's baloney. It won't sustain. But it didn't. In March, the first hard month off that high, we went major bearish, because you've got a trend line here on price, but we had one on momentum that broke way up there at 104 level.
Okay.
That would be in March, okay? We dropped down to 124 close was that month. And then you dropped hard into April, May. June is now blown through your price trend, but it's also blown out another annual momentum structure at that point. We're maximally bearish on the dollar index. But what's happened here is here's a major factor in markets, Forex exchange rates. This is primarily the dollar index, is primarily the euro and the yen. Combined, they constitute 70% of the dollar index. But there's nothing been going on between 23 and 24 in terms of any volatility. So it was not a wave maker, didn't have impact in other markets. Now, I understand that foreign investment in the US stock market over the last few years has grown to levels it's never been before. Very high. But they are affected by not just the price of the S&P, but by, they took the euro and the yen and bought dollars and bought our stocks. Okay, so they're dollar vulnerable. So if the dollar suddenly drops from where we said sell it at 104 in March, 104, it's now down to 96. That's starting to have an impact on somebody who holds assets in the U.S. Forget whether that asset went up or down, but suddenly you've chopped that much off the conversion value of that asset.
Right.
So that could help weaken the stock market, and also maybe people who own long U.S. government debt market. They're being impacted by this. While the bonds are sideways at a strangle level, in conversion terms to a yen or to a euro, you're getting hurt.
So, isn't this jet fuel for a lot of commodity companies though? Because a lot of commodity companies are based out of Canada, Australia, foreign currencies.
I think it will help assist gold. It's not a primary driver for gold. In the long term, it is. Ultimately, the degradation of money is always an underlying factor for gold prices. In the short term, it's suddenly taken a sharp drop, and if it starts to drop more precipitously, that will turn heads, and that will help fuel gold more. But also the commodity complex looks ripe to do just the opposite of what you're seeing here. You're getting a major breakdown in the dollar after a couple of years of sideways. Well, what did Bloomberg do? Went sideways between 23 and 2024, bottoming. This guy went sideways, topping between those same years. And now suddenly he's broken out to the downside. Bloomberg is 3.5 points away from breaking out to the upside on our long-term metrics, annual momentum. Right now it's around 103. You get to 106.50 on a monthly close and you're out of here. So it's an inversion of the commodity complex. You're right. So I think it will be a further fuel for the commodity markets and the stocks related. Yeah.
If you're not paying close attention right now, you might miss what I believe is going to be one of the most profound inflection points in the modern financial era. And no, I'm not being dramatic. I'm just reading the momentum. Because momentum doesn't lie, and right now it's screaming louder than the headlines. We've entered a phase where many markets that have been effectively dead for the better part of 2 years are beginning to stir again. And not just with gentle volatility, but with decisive structural shifts. The type of moves that change narratives, portfolios, and even political regimes. And it all begins with one thing: the truth breaking through the noise. Let's start with the stock market. Back in early January of 2025, we turned decidedly bearish on the S&P 500. At that time, the market was still levitating around the highs, and it even made a marginal new peak, teasing the breakout crowd and reassuring those clinging to the soft landing fantasy. But we saw something very different under the surface. Our momentum metrics broke well before price did. And as I always say, momentum precedes price. What came next wasn't just a correction, it was the beginning of a fracture. The bounce that followed, totally expected. We projected a rebound to the 4,800 zone, which had been a prior peak back in 2022. Why? Because price traders always anchor on prior highs, and structurally, that's where some oversold conditions were setting up. That bounce, however, didn't change the broader bearish trend. It only bought time for late bulls to exit gracefully. Most didn't. Now I want to take you back to some historical analogs, because if you understand how tops form, not in the moment, but looking backward, you begin to see a rhythm. Go back to 2000, the dot-com peak. We put out a report literally on the first trading day of that year saying, "This is it, be gone." Sure enough, a few weeks later, you had a drop, then a final marginal high in March that made the permabulls say, "See, we're fine." But momentum was already broken. That final uptick was the last gasp of a terminal phase. And what followed was a slow-motion train wreck that lasted nearly 3 years. Investors didn't believe it until they'd lost 40% of their wealth. Same story in 2007. We had the S&P climbing back toward its 2000 highs, and in late 2006, we projected a top between 1550 and 1600. Sounded crazy at the time, since it implied breaking the prior peak. But we knew the difference between nominal highs and structural strength, and sure enough, it peaked in 2007, just above 1550, rolled over, and you know the rest. Mortgage crisis, recession, global panic. But here's the kicker. By the time most retail investors realized the market was breaking down, it was already too late. That's the cruelty of delayed awareness in markets. Price fools people. Momentum, if you listen, gives you a head start. Now fast forward to today. The bubble we just emerged from makes 2000 and 2007 look quaint. The duration, the magnitude, the liquidity, it's all off the charts. The Fed pushed M2 like never before, negative real rates, quantitative easing on steroids, and zero fiscal restraint. And now they're pretending they can unwind it. But the unwind is not a taper, it's a reckoning. You cannot remove liquidity from a system built on debt without structural pain. And that pain isn't coming. It's already here. You just haven't felt it in the headlines yet. Let's talk bonds. The bond market used to be boring, not anymore. We're now seeing a refusal to absorb new debt at the current yields. That's not just about inflation expectations, it's about trust. When trust in future purchasing power declines, long-duration debt becomes radioactive. This is why we're seeing failed treasury auctions, growing term premiums, and widening spreads. And it's not just technicals, it's fiscal. The US is running $2 trillion deficits in what they call a strong economy. Imagine what happens in a recession. And by the way, we're not forecasting a recession. We're saying we're in a rolling recession already. Look at commercial real estate. It's imploding. Look at manufacturing indices. Look at credit card delinquencies. The Fed may claim unemployment is low, but employment is always a lagging indicator. What matters is earnings, hours worked, and disposable income. All of those are weakening. So now we have a market that's pretending to be healthy on the surface while the internals rot. That's the kind of setup that leads to abrupt repricings. And that brings us to the dollar. The dollar has been range-bound for 2 years, and people mistook that for stability. We warned repeatedly that once the range broke, it would be dramatic. In March, the DXY began to lose support. Momentum broke even before price did. And now you're seeing a sustained move downward. We dropped from 104 to 96 in a flash. This isn't noise, it's the beginning of the end of dollar strength as a structural assumption.
I think that the next 6 months, the next couple of quarters are just going to be pretty dynamic in most markets, including some markets that have been dead asleep for a couple of years. I'll get into that in a minute, but stock market first. We turned bearish on the S&P in early January of 2005. And 2 weeks later, it went up and made a marginal new high. And it's clustered up there for quite a few months. You'll see it just sort of, new highs, but it really wasn't going anywhere. But anyway, it finally fell apart in February, March, April. Okay, and we had news at the tail end of that, the tariff stuff. Okay, fine. When the drop began, we put out a report projecting that there would be a bounce point. And the bounce point we projected would be 4,800 area. And the reason for that was back in 2022, there was a high at 4,800. And we figured the price guys would buy the old high. Okay, yeah, you see it there. Now, there's other reasons too. There wasn't just the silly price chart line across the thing. It was some momentum reasons said, no, when you get there, you're going to be oversold. You need to bounce. Even if you're in a bear trend, you get oversold from time to time. You need the correct upside.
Right.
And sure enough, it bounced, and we didn't project that it was going to make a new high. But we have focused on our prior history of stock market tops and what we've said and so forth. And when we go back to 2000, there are two major bull tops in the last 25 years. 2000, the dot-com high, and the other one was 2007, prior to the mortgage real estate crisis. In 2000, when you made the high, in January, first trading day of that year, 2000, we put out a report that said, okay, be gone, okay? You go a little bit further to the left there. Just prior to that drop, you see that it's right under the hand. There's a little drop there. Yeah, that was from January through February. And then you turned back up and made a new high in March. That's that peak candle there. Yeah, it wasn't major high, but it was a new high. And people said, oh, you see, you were wrong. We said, no, this is a top anyway, because price may be doing this, making you tease you with a new high. Marginal, but momentum says no, you've broken the backbone of this beast, and therefore any rally you get is counter to the momentum trend. Okay. Structural breakage, it wasn't corrected by that rally in March, but it made the longs feel very comfy. And if you look, it wasted the entire year of 2000 laboring either side of your first circle there, that little circle in January. I mean, it was up and down, but it wasn't going anywhere, but yet it felt good because you'd made a new high. In fact, in August, on a monthly closing basis, that was a new high monthly. It was only in the rollover there. See that first drop you see into early 2001? Yeah, let's start there. That low that you see where there's a spike rally after that. Go further to your left, back over to take your crosshairs up to the left. Anyway, you got down to 1,300 and something and then bounced. That was a Fed rate cut. The first rate cut they'd had it over a year. They'd been in pause mode.
Oh, here, back.
Yeah, no, further left. Yeah, here. Right there. That was a rally caused by a Fed rate cut. They had ceased cutting rates a year earlier. Okay, and it was in other words, you're in a pause. They came in January and said, oh, no, they cut rates twice that month, in fact. If you shorted into the rally that followed those rate cuts, you nailed it pretty good because then the bear market really started. Even in January of that year, 2001, you weren't really that far off the highs. People didn't realize you were in a bear market. It was only later in 2001 that you started to come apart.
So let's keep going down this road. Where we left off, we were watching silver start to shake off the dust and run. And when silver runs, it's not a jog, it's a stampede. You don't want to be standing in front of it. We're already well past $36 on September contracts, and the charts don't show exhaustion, they show coiling. You don't coil like that unless you're ready to spring. If this market sniffs $37 again and pushes, it'll make those last dual highs at $50 look more like a speed bump than a resistance line. And if you're holding out thinking we're going to see a meaningful pullback first, you might just get left behind in the dust trail. This isn't a fake breakout, it's a structural regime change in the monetary metals, and silver's just now waking up to what gold's been whispering since last year. Gold, for its part, is doing what gold does in the late stages of monetary confidence. It becomes the eye in the center of the hurricane. When the dollar starts to shake and treasury demand gets sketchy, when the illusions of strength start to fray, gold doesn't panic. It simply moves higher, quietly, powerfully, and with fewer people noticing than you'd expect. And that's what makes this moment so fascinating. You've got institutions, hedge funds, and now even certain sovereigns rotating into gold quietly. Nobody rings a bell at the bottom or the breakout, but if you pay attention to the internals of the move, the momentum shifts, you'll see the bell tolling all right. And it's not tolling for equities. Speaking of equities, remember when everyone thought the Magnificent Seven stocks were going to save the world? That we could just inflate our way into tech-fueled prosperity and there would never be a reckoning? What we're seeing now is a kind of echo from the past, a redux of the 2000 to 2002 unraveling, but with a digital face mask. It's cute to see people still clinging to narratives that worked in the QE era when the Fed was the permanent bid under everything. But now we've got something more stubborn in the room. Stubborn inflation, stubborn real rates, and stubborn deficits. Those don't vanish just because Nvidia hits another record PE multiple. Let's talk about those deficits. The fiscal trajectory of the US is no longer just unsustainable. It's gone from theoretical problem to mathematical certainty. We are adding over $1 trillion in debt every 100 days. That's not rhetoric. That's from the Treasury's own data. When debt issuance becomes the core driver of your economic activity and the only buyers left are either forced, like pension funds, or desperate, like central banks, then you've got a powder keg. The market knows it. The bond market smells it. And foreign holders, they're slowly tiptoeing toward the exit. Now take that and layer on a weakening dollar. The DXY's collapse beneath 104 and now under 96 tells you something very basic. Belief is evaporating, not just in the Fed's ability to engineer a soft landing, but in the very structure of the post-Bretton Woods system. This is the first time since the early 2000s that we're seeing an erosion in dollar momentum while gold and silver rise, not just as inflation hedges, but as base currencies of trust. And here's the thing, the dollar index is just a mirror. It's a basket of comparisons. But if the euro and the yen are also weak, and the dollar is falling against them, then you know what's really going on. Capital is moving to tangible assets. Let me paint a picture. Imagine you're a European investor. You've watched your currency erode, your yields go negative, and your purchasing power dwindle. Do you want to hold euros, dollars, or physical metal? That choice is becoming clearer by the day. And for those watching the Japanese yen, which is being lit on fire with BOJ's yield curve control, the choice is practically screaming at them. We're seeing early signs of capital flows exiting currency and debt markets and heading into commodities, not for profit, but for preservation. This brings me to the broader commodity complex. The Bloomberg Commodity Index has been dormant for 2 years, but look at it now. It's coiling. Momentum says it's about to break out. Why? Because hard assets don't lie. Paper assets are statements of hope. Commodities are statements of fact. You either need them or you don't. When you look at the copper market, you don't just see a base metal. You see a barometer for infrastructure spending, green transition, and industrial activity. And when you see copper pushing toward new highs while the dollar rolls over, you realize this isn't just a trade. This is a shift in narrative. Oil is another case. The events in the Middle East haven't just disrupted flows, they've reignited the geopolitical premium that had been artificially suppressed. A shutdown in the Strait of Hormuz, even partial, isn't just a local event. It's a global price driver. And while WTI isn't at 150 yet, you can almost smell the nervousness in the futures pits. The speculative crowd is underweight, and the commercial crowd is hedging cautiously. That tells me oil could be the next sleeper to wake up. All of this paints a picture of a market ecosystem in transition. We are exiting the era of financialization and entering the era of tangible value. Gold and silver are simply the canaries in the coal mine. And what's most interesting is that the mainstream still doesn't believe it. We've had a stealth bull market in gold since late 2022, and most CNBC viewers still think the real asset to own is Apple or a yield-bearing ETF. They're going to be late, as always. And let's take a step back and laugh a little, because it's almost comical to watch Wall Street analysts update their models every quarter with 17 decimal points of precision, pretending we can predict the future when we don't even know what tomorrow's headlines will be. War, pandemics, debt crises, bank failures. These aren't black swans anymore. They're part of the weather report, and yet the models still assume normalcy. That's where the opportunity lies for those of us willing to detach from the groupthink and watch the underlying shifts. Now, I've said before, momentum precedes price, and we're seeing this now in silver, in gold, in the dollar index, in commodities broadly. If you're waiting for confirmation from Bloomberg or the Wall Street Journal, you're going to get the news a year late. That's not how this game works. The market tells you in whispers before it tells you in screams. The whisper right now is that fiat credibility is cracking. The scream will come when delivery fails in the metals market or when treasury auctions go no bid. And speaking of delivery, let's not ignore the structural issues at COMEX and LBMA. We've seen paper to physical leverage at all-time highs. When silver trades 200 times more contracts than ounces available, that isn't liquidity. That's leverage addiction. At some point, that blows. Could it be from Russia or China demanding delivery? Possibly, but more likely it'll come from within. Some large player deciding they no longer trust the system and want the metal. That's when you see the musical chairs game end. Let me bring in something a bit more visceral. Do you remember 1980? I do. Silver hit $50 and gold exploded. That didn't happen because of macro models. It happened because trust evaporated in real time. And the funny part is, compared to today, that crisis was a campfire compared to the forest fire we're building now. Debt to GDP is higher. Derivatives exposure is greater. Monetary expansion is on a whole different scale. and public trust in institutions at all-time lows. So the setup is clear. Momentum is aligned. Price is confirming. Macro conditions are deteriorating, and the public is still asleep. That's the sweet spot for positioning. And this isn't just a bet on metals. This is a reallocation of worldview. It's a bet on scarcity over excess, on history over hype, on reality over narrative. I'll close with this thought. Every great rotation in market history has begun not with a bang, but with a whisper. The smart money rotates quietly. The media covers it late. The public panics last. We are somewhere between quiet accumulation and growing institutional awareness. The real rush hasn't begun yet, but when it does, the metal won't wait for you. There will be gaps, there will be premiums, and there will be regret if you're not already positioned. So keep your eye on the momentum, not the noise. Watch the trend lines, not the talking heads, because by the time the bell rings, the train may already be gone. And if you're wondering whether it's too late, it's probably still early, but not for long.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.